Hello everybody and welcome back. In this video I will show you how to analyze stocks like Warren Buffett, how to pick great stocks that will outperform the market for the long term. I will give you specific tips, specific frameworks that you can use right away. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now and I have achieved a performance of more than 20% per year. So I have applied the principles from Warren Buffett. These are common sense principles that have been working for decades, that are working now, and that will continue to work for decades. And the first point is very simple. The first point is about the circle of competence, which means you will look at many stocks right now on YouTube, on Twitter. You have to remove 99% of the stocks you're looking at. You have to dismiss 99% of the stocks you're looking at. You have to spend maximum 30 seconds for 99% of the stocks out there. You have more than 50,000 stocks available in the world. Why would you focus your attention, spend some time on stocks that you will never buy either way? Because that's out of your circle of competence, out of your understanding. For example, if you're watching this video, would you invest in a nuclear fission company? Would you invest in a motorbike company in Malaysia? Would you invest in a rocket company from Spain? Would you invest in a toothbrush company in France? If you're comfortable with these industries, maybe. But I suspect these different industries will attract different investors. It's okay. You don't need to be invested in everything. You can focus on one single niche in your circle of competence and stay inside your circle of competence, okay? And the first principle that we learned from Warren Buffett is having the discipline to say no to almost everything, which means you have 3 piles of stocks. Yes, no, too hard. The too hard pile. And you need to have the discipline to put 99% of the ideas that you see on YouTube, on Twitter, on Substack in the too hard pile. I know it's very simple saying this, but in practice, nobody does it. Very few people are doing this. And this is a mistake I see for many retail investors because you have this shiny object syndrome. You are watching a YouTube video and you say, why not this one? You are looking at Twitter and you say, oh, why not these stocks? You are reading a Substack article and you say, okay, why not? Let me spend some time. You have to know in 30 seconds if this is a stock for you or not. And I'm telling you, the majority of stocks are not for you. Only a minority of companies will fit your filters, your understanding, some things that are within your circle of competence. I know it very well. I've been doing this for a decade. 99% of the stocks, you just dismiss them and you focus all your attention span to the remaining 1%. But for the remaining 1%, you know them very well. You know these stocks very well. You know everything about them. You go deep, deep, deep in the research. And this is how you can find an edge in the market. You don't need to know everything in the stock market. You need to know a selection of good stocks, buy them at a good price, and hold for the long term. Why would you spend your valuable time looking at everything at the same time? It's impossible. Now AI is very sexy. So maybe you will be seduced to do a lot of research about AI, chips, or some potential companies that will implement AI. If this is not within your circle of competence, you are literally wasting your time. It's much better to focus all your attention to what you're best at. For example, if you are a software engineer, you know the software industry much more than the majority of people. So your circle of competence is software. If you've been playing golf for 50 years, you know the golf industry very well. If you've been working with the snow and big machinery for 20 years, you know this industry very well. You have an edge. Use this edge. You don't need to be invested in a rocket science project. You don't need to be invested in Tesla. You don't need to be invested in Apple if you're not comfortable investing in these companies. It is fine. You can stay within your circle of competence. And what is really important when you assess your circle of competence is not to have the widest circle as possible, the biggest circle of competence ever. The goal is to know, to differentiate what is outside your circle of competence and what is inside your circle of competence. And if you don't know this, please spend the next hour on Gemini, on ChatGPT, and ask questions to the LLM to really know what you're good at. If you don't know what you're good at, the LLMs are free. Use ChatGPT, use Gemini, do whatever you want, but you have to find your edge. What is your edge? You are a person with a track record, with a job, with a specific geography. You know things that I don't know. You know things that other people are completely missing. This is your edge. So use your edge, okay? So that was the first point, because Warren Buffett is known for browsing through many stocks, thousands of stocks. But he was always very selective about his companies, his stocks. Now, Berkshire Hathaway is quite big and Warren Buffett is retired. But if you go back in history, in the 50s, 60s, for the first Buffett partnerships, the portfolio was very concentrated, very niche companies in insurance, for example, insurance companies. This is his circle of competence. If you look at Warren Buffett, he made a lot of money with banks, insurance companies. He did not make a lot of money on retailers, for example, shoes companies. It's not inside his circle of competence. So he just doesn't touch these stocks. He was burnt with the Dexter shoes, and that's pretty much it. He learned the lesson of going outside his circle of competence, and he stayed within his circle of competence, and he has averaged 20% per year for 50 years. That's a pretty good performance, the best performance ever. So just follow this advice from Warren Buffett, the god of investing, so you can invest in the best possible stocks. You dedicate all your attention, all your energy to the best 1% of companies that you understand really well, okay? By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. Second point, for all the companies that are in the top 1%, you need a track record of being profitable. You need to invest in companies that have always been profitable, okay? Which means you can reverse engineer this. Which companies don't have a track record? The IPOs. So if you want to really invest with Warren Buffett, you avoid IPOs, or you just invest in one, for example, in your portfolio. But as a speculative play, the majority of your portfolio should be companies that have a track record of being profitable in the past, for the past 5 years, for the past 10 years, for the past 20 years. If a company has always been profitable, they will survive the cyclicality. They will survive in case we have a recession, for example. Most companies that are profitable for a while, they manage their balance sheet in a conservative way, so they don't have much of a debt problem. They can repay their debt with their cash flows. This is okay. But you want to avoid companies that are cyclical. You want to avoid companies that are making losses and losses and losses. So now we go from a top 1% to the top 0.5%. You can just remove half of the companies that are not profitable whatsoever. Third point for you, you want integrity from the management team. Now we are not talking about numbers, we are talking about the qualitative aspects, how to invest for the long term when you invest in management teams. Some CEOs are great. Some other CEOs are lying. You have to do the work, do the research to identify CEOs that are lying. How do you know if a CEO is lying? Well, first, you can spot things on the internet. The most common way of doing it is to know what is the guidance from the management team and to see if they underpromised and over-delivered, or if they over-promised and under-delivered. Some CEOs are making huge assumptions about the future. They think they will grow in the next 3 years immensely, And then you look at the track record and it's bad. They don't grow as much. So they promised the moon and they did not reach their goals. And if the management team has been doing this for 20 years, it's bad. No integrity. So you want to only be invested in companies that are conservative in their guidance, under-promising, but very skillful in execution, over-delivering. You have a couple of companies that are doing this. I can give you some names. Pool Corp, under-promising, over-delivering. Fair Isaac, FICO, under-promising, over-delivering. Every year they have a guidance. They beat their guidance. Well, we think we are going to grow 15%, they grow 20%. Or we think we are going to grow 10%, they grow 15%. Every time it's better than anticipated. So you want integrity from the management team. Insider ownership is better. You want to avoid management teams that are lying to the public. You have many examples of companies that are lying to the public, making huge assumptions and not delivering after a couple of years. It's very bad. And if you don't know how to identify this, you can use LLMs. You have a couple of tools, you have a couple of websites that will help you identify this. And you can also do the work. Watch some interviews from the CEO. Read the annual reports, what the management stated in the past. You can check the investor presentations. What was the guidance 3 years ago? For example, if a company made an acquisition in the past, 5 years ago, maybe you can find a slide deck, investor presentations the company shared 5 years ago. Here is our acquisition. Here are all the synergies we are expecting. Now, 5 years from now, 5 years have passed. You can check if the synergies happened. Okay? So what the projections were in the past and what the reality is right now. If the management was too conservative or too bullish, and if the management team was too bullish, ask why. What happened that suddenly the business is not as great as people thought? You have to ask questions, do some due diligence. And I'm telling you, it will take you a couple of hours to do this. It's not easy. And it will give you a lot of value. You will discover a lot of things. It's not about numbers. It's not about quantitative analysis. It's about qualitative data. Qualitative analysis, the tone of the management team, okay? The guidance, how the management reacted when faced with adversity. This is how you can only invest in the best companies. You want to see if the management has integrity, intelligence, and resilience when they have issues. Okay, so you want to check this to be invested in quality companies that will outperform the market. Warren Buffett is known for saying, you can lose money for us, but you cannot lose 1% of integrity. Okay, integrity and reputation were the cornerstones of Berkshire Hathaway. Warren Buffett has built an immense reputation of being trustworthy, which means you need trust in the process. You need to trust the management teams. So you need integrity. You need good quality management teams. I hope that's clear for you. Also, 2 points for you. For the companies that you want to select the Warren Buffett way, we said you want them to be profitable. You need conviction and estimate that earnings will grow for the next 5 years with 90% accuracy. You have an ex-manager from Berkshire Hathaway called Todd Comps, and he had an interview a couple of years ago and a couple of frameworks how he selected the best stocks for Warren Buffett. And one of the points was you need to assess with 90% accuracy in your head, like conviction, that the earnings will have to grow for the next 5 years. If you're not dead sure that the earnings will grow, maybe don't invest in the stock. Choose something else. So for all the companies you have in your portfolio, if you want to invest the Warren Buffett way, you need to be extremely confident earnings will grow in the future, in the next 5 years. Okay? So not all companies will fit the mold. Not all companies will show sustainability of returns. But I can give you some examples of companies that will almost for sure increase the earnings. Look at Visa. Look at MasterCard. It's almost certain that revenue will go up in the next 5 years. Earnings will go up in the next 5 years. Free cash flow is up for the next 5 years. And if you're doubting what I just say, just check the track record. As always, they have uncertainties. As always, they face challenges. But as always, they grow. Maybe not grow 20% per year, but they grow. You need to be almost certain earnings will grow. You want to avoid the value traps, okay? And the last point is, if you want to invest in stocks the Warren Buffett way, you need to have a reasonable valuation for all your stocks. So you want to avoid companies that are extremely expensive. PE ratio of 60, PE ratio of 70. You can measure the valuation of these companies based on PE ratios, price earnings ratios, because they have earnings. So a PE ratio is a pretty good indicator to measure the valuation of companies, of stocks. So now you have all the tools to invest like Warren Buffett and to finally outperform the market. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.